Good afternoon. My name's Scott Kennedy. I am a senior advisor in the Freeman Chair in China Studies here at CSIS, and it's a delight to be able to invite you here to today's book forum on a new IMF book, The Future of China's Bond Market. Now, yesterday, the Freeman Chair hosted an event about the grand sweep of Chinese history from 1644 to the present. Some of you may have been in the audience or watching online. And we talked about everything under the sun over several hundred years of China and connected that to where China's role in the world today and where it's going. We're going to take a slightly different perspective on China today. We're going to look at its economy, its financial markets in particular, and what that means for China's place in the world. Both are incredibly important, and we're very fortunate to be the host of both kinds of perspectives on this extremely important country. I've been following Chinese economic policy and financial policy for many years, and have always been interested in where the financial sector goes, but it's an area that's extremely difficult to grasp, but there's always important signs of things that you need to follow. Americans, of course, we pay a lot of attention to stock markets, but we should need to pay more attention to bond markets. I've been interested in China's bond markets for a long time because as a political scientist, I'm particularly interested in the power of credit rating agencies and other non-state sources of authority in shaping public goods. I haven't had a lot of chance to have events and programs about this aspect of China until today. And luckily, we have the key source of authority in the world about financial markets and China's bond market, and that is with the IMF and the team that has put together today's book. I want to turn things over now, before we get to the discussion of the book, to Changyong Ri, who is the director of the Asia and Pacific Department at the IMF, where he oversees the fund's work on the region, including its lending operations and bilateral and multilateral surveillance of economies ranging from China, Japan, and India to the Pacific Islands. Prior to joining the IMF in February of 2014, Mr. Ri was chief economist at the Asian Development Bank, and he was Secretary General and Sherpa of the Presidential Committee for the 2010 G20 Seoul Summit, and Vice Chairman of the Financial Services Committee, and Chairman of the Securities and Futures Commission in Korea. He's going to offer some initial opening remarks. I'll then come back and introduce the book co-authors, and we'll go from there. So please join me in welcoming Mr. Ri.
Scott, thanks very much. Let me first say that actually this speech was supposed to deliver by our first Deputy Managing Director, Mr. David Lipton. So he has some other issues, so he asked me to deliver his excuses that he missed this important opportunity. But for me, I'm very glad that I can use his good speech without contributing anything to him and get some credit. So from now on, my job is to read his speech one by one. So pretend that I'm a David Lipton. So it's a good thing. Okay, anyway, so good afternoon. Thanks for joining us today to mark the publication of International Monetary Fund's new book on the future of China's bond market. And I just got the hard copies. And I'd like to thank Mr. Matthew Goodman and Mr. Scott Kennedy of CSIS for organizing and sponsoring this event. We at the IMF always appreciate our interaction with CSIS, and CSIS provides a programmatic voice for international cooperation, regardless of whether that international cooperation is in or out of favor at this moment. And this is most decisively a moment where the balance seems to be in doubt. Over the past 40 years, China's era of reform and opening, we have come to regard the trade links and supply chain that have spread across the globe as the main tie that bind international countries. But these economic relations and the prosperity that have helped foster may be more fragile than we have assumed. The most recent signals of reduced U.S.-China trade tensions have offered reasons for hope, but we will have to wait and see. All of which seems a long way from China's bond market, but not really. The publication of this book comes on the eve of another important milestone in China's integration into the global economy through its financial sector. Next month, bonds issued by the Chinese government and policy bank will be included in Bloomberg's Barclays Global Aggregate Index. That step both reflects the importance of those bonds in foreign portfolios and likely will encourage more purchase of those securities going forward. This development follows the establishment in 2017 of the so-called Bond Connect, which allows foreigners to enter the Chinese bond market, as well as the authorities' recent commitment to further develop an open Chinese market. The rapid growth of China's bond market into the world's third largest and its further opening to foreign investors are important steps for global financial market integration. Until now, China's financial sector integration has lagged far behind in its role in product and commodities trade. Except for bank lending to developing countries, China's financial system remained relatively closed, and also domestic financial system remained largely bank-centric and bank-dominant. Bond market development and global integration will be a beneficial step for the allocation of resources, better allocation of resources within the Chinese economy, and will spur greater asset diversification in China and globally. It can also help boost China's economic growth and, in principle, strengthen financial stability. It is also a positive signal that China is opening further to the world at a moment when its other economic linkages are facing intense scrutiny. Financial sector reform is an important element of China's current transition, and from 4 decades of high-speed growth towards what is intended to be high-quality growth, and the reform remains a work in progress. As with any asset class, the process of developing and opening the bond market need to be managed carefully because ensuring financial stability remains crucial. Of course, integrating the bond market into the global financial system is a step toward a more open capital account, which could present challenges during a period of instability. This was something we witnessed in 2015 when volatility in China's market had strong ripple effect worldwide. So to minimize risk and maximize the benefit of integration, it is essential that China continue its reform program. Some steps would be bond market specific, such as measures to improve market liquidity and harmonize regulation for foreign and domestic investors. Others would require time and significant political capital. And let me highlight and give some examples in 2 areas. First, removing implicit guarantee. Bond market require adequate pricing of risk to allocate resources efficiently. This means removing China's widespread use of those guarantees. This calls for allowing non-viable business to close, which in turn means the strengthening of resolution framework and some safety nets. These are the recommendations that IMF has been making for some time. Second, improve corporate governance. Efficient capital market require timely and reliable information, especially on corporate performance and outlook. So continued progress must be made on the governance reform of all companies, state-owned or private. Clear lines of communication about the direction of policies also would be greatly beneficial, especially in terms of reducing market volatility. This is one area where the People's Bank of China has made important strides by holding more frequent press conferences and providing more real-time information in English. My colleagues emphasize this point about communications in this book. Financial market integration, built on internationally accepted rules and transparent regulatory practices, can provide the fundamental foundation for a strong economy. and it can serve as an example of best practices in building cross-border economic ties. This would also be a sign of progress at a time when international linkages are under pressure. So I congratulate the authors for their work on this book, which integrates the perspective of experts from China and Hong Kong SAR, and this includes important contributions by Chinese officials involved in the progress of finance sector development. I look forward to working with China on this effort, and I look forward to continuing our cooperation with CSIS. Thank you very much.
Thank you so much, Dr. Rhee. Today's event isn't a Freeman Chair event alone. We are cooperating with the Simon Chair in Political Economy. The leadership of the Simon Chair is abroad right now. They're suffering in Paris at meetings there. But we do have, as one of our commentators, I'll introduce in a while, someone who is a non-resident fellow with the Simon Chair, and many of you from the financial community and Treasury know Mark Sobel, and I'll introduce him in more detail when we get to that part of the program. Today's event is not the first time that we've collaborated with the IMF. In fact, we co-hosted with the Simon Chair a book event 2 years ago when the IMF released its book, China's Soft Infrastructure. It looked at a whole variety of types of institutions that China needed to build in order to have sustained development, economic growth over the long term. That went really well. The book received a lot of positive attention, and so we are here again for another opportunity. As then and now, one of the editors for the book is here with us, along with some of the contributors. Alfred Schipke is the IMF's senior resident representative for China. In this capacity, he provides policy advice, leads the analytical work of the office, and coordinates the IMF's capacity-building activities in China. He was previously division chief in the Asia and Pacific Department at the IMF, where he coordinated the work on fast-growing, low-income countries in Southeast Asia and led missions to Vietnam. He is a research professor at the National School of Development at Peking University and also teaches international finance at Harvard's Kennedy School. One of the contributors who is here with us today is Ding Ding. He is Deputy Division Chief in the Caribbean #1 Division of the IMF's Western Hemisphere Department. He was previously the Senior Desk Economist on the IMF's China team and has also worked on advanced and emerging market economies, including Australia, Korea, New Zealand, and Sri Lanka. And he has published research papers on a variety of topics, including macro-financial linkages, monetary policy transmission, and the Chinese economy. He received his PhD in economics from Cornell University. In addition, also with us today is Fabio Natalucci, who is Deputy Director of the Monetary and Capital Markets Department at the IMF, with responsibility for the IMF's global financial markets, monitoring, and systemic risk assessment functions. He is responsible for the Global Financial Stability Report that gives the IMF's assessment of global financial stability risks. Prior to joining the IMF, Fabio was a Senior Associate Director in the Division of Monetary Affairs at the Federal Reserve Board, and prior to that was Deputy Assistant Secretary for International Financial Stability and Regulation at the U.S. Department of Treasury. Fabio holds a PhD in economics from NYU. So let me invite Alfred and the two contributors to the stage to present the findings from their book. Alfred.
Thank you very much, Changyong Rhee, for the opening remarks, Scott Kennedy for the nice introduction. It's a real pleasure to be here at CSIS again, where I think we are able to have an open discussion on the future, this time on the future of China's bond market. Before I get started, I wanted to highlight again that this is a product that brought together many departments at the IMF, and we're particularly proud that we had a number of contributors from the Chinese authorities, including the People's Bank of China, the Ministry of Finance, and the securities regulator. So this is really a joint product. And if you work on bond markets, it is important to bring together international experience, solid economic analysis, but also detailed institutional knowledge. So what I'd like to do is I'd like to set the stage a little bit for the discussion and then zoom into the bond market, the government bond market. And then my colleagues will follow up by focusing on particular segments of the market and some of the reform issues that need to be addressed. So here we are. Last year, China celebrated its 40th anniversary of reform and opening up. And what that has given to the world is trade integration, product integration, and of course has contributed to China's rapid economic growth. At the same time, China's financial sector has also developed rapidly and is now large. China has the largest banks in the world. It has the second largest equity market, and even the bond market, the focus of our discussions today, is the third largest in the world. But let me just highlight two particular phenomena in China. Despite the fact that China's financial sector now is very, very large, it is very bank-centric. So the allocation of savings and investments largely takes place throughout the banking sector, which is pretty unusual for a country of the development of China. For example, if you look at the financing of corporates in China, most of it is still through bank financing, and bond financing plays only a little role. The other part is external connectivity, and that's something that Changyong already highlighted. Despite its trade integration, product integration, China's financial sector remains relatively closed. In this figure here on the right-hand side, where red is China, and we compare it to a number of countries, of course, it is not the United States, so it's maybe not surprising. But even if you compare the share of foreign owners of bonds in China and compare that to India, China is still relatively small, less than 2%. What does that mean when you think about the future of China's bond market? I think it means two things. First, most likely over the next decade, we will see that the bond market as part of the whole financial system will become more important. That doesn't mean necessarily a capital markets oriented system like in the United States, but just more important in relative terms. And the second part is that there is significant room for further integration of China's financial sector globally. Another way to think about the future is when you look at reserves and the reserve holdings of foreign central banks in terms of RMB bonds. What we have seen is that since the inclusion of the RMB into the SDR basket in 2016, we actually have had increases in reserves held by central banks abroad of more than 100%. And this map here is based on a paper that was produced by a colleague of ours, looks at the co-movement of exchange rates vis-a-vis three major currency blocks. So you have blue is the United States, green is the euro, and red is the RMB. And what it suggests is that there's a high co-movement with the RMB. Now, that suggests that maybe we're moving from a bipolar to a tripolar international monetary system. And if that's the case, then potentially there could also be additional demand for RMB bonds. But when you think about the future of China's bond market, it depends on, of course, on a number of factors. Let me just highlight two. First, it depends on policies. And here, the Chinese leadership and the government has clearly articulated two things. First, that it wants to further open up its financial sector. And as the Premier Li Keqiang last week at the National People's Congress highlighted, it wants to further open up its bond market. And secondly, within the Chinese financial system, it wants to develop further the bond market to ensure that the real economy has better access to financing. Those are the policies. The second one is how the private sector acts. And the inclusion of the Chinese government and policy bank bonds into the first global index is a sign that the global community is looking at China's bond very differently, which will ultimately lead to additional inflows. Now, being here in Washington, D.C., where everybody, I'm sure, has been focusing on trade over the last couple of months, maybe year, let me be a little provocative and kind of argue that while everybody has been focusing on trade integration, maybe the next decade will be all about China's financial sector integration. And that brings many opportunities for investors globally to divest, to diversify their portfolios, the provision of further safe assets. But of course, this process needs to be carefully managed. And also for those who ultimately want to get into the Chinese bond market, have a better understanding of some of unique characteristics. And that, of course, is part of our book. Now, when we think about the future of China's bond market, it is, of course, important to take into account two phenomena. First is, what is the domestic macro-financial context? And the other one, when you want to open up further, what is the external context? And so it might be important to go back a few years and you remember that China relied on credit growth. It leveraged up its economy. That created a whole range of vulnerabilities that the IMF and others had focused on before. And as a result of that, in 2017, the authorities started what was called a multi-year deleveraging campaign to basically stabilize leverage ratios in China. Now, as a result of that campaign, a few things happened. Credit growth slowed. You also had an increase in defaults. Here it might be worthwhile pointing out that the defaults were mostly in the private sector, not state-owned enterprises. And secondly, you had credit spreads increase. Now, this is not necessarily bad, as Chang Yong was arguing further. As you're removing implicit guarantees, it is important that risk is priced accordingly. Now, over the last couple of months, what we have seen is that the Chinese policymakers are recalibrating their policies, which might be warranted. But of course, it's important to keep in mind that the progress has been made in reducing vulnerabilities, that is not undone. Now, when it comes to the further opening up of the economy, there is, of course, this issue about the normalization of interest rates globally, and what will happen to the global financial cycle. Remember that when advanced economies engaged in expansionary monetary policy, unconventional monetary policy, that led to significant flows into emerging markets. And of course, there's the risk that that could be reversed. Now, some people have argued, well, currently, China is not connected to the global financial cycle so far, and if you open up further, that brings certain risks. Well, that is important to take into account. Our view is that should not stop the process, but rather ensure that China moves forward in having a more flexible exchange rate system and to strengthen its monetary and fiscal frameworks. If that is done, then China will continue to maintain monetary policy control. Now, let's just a few words on the structure of China's bond market. It's interesting that today, 60% is basically government or quasi-government. That means it includes bonds of the central government. It also includes the bonds of policy banks, which basically have the characteristics of government bonds. And the largest segment actually is the local government bond market. Some of you might not have even heard about China's local government bond market. It basically overnight, since 2050, became one of the largest in the world because the government engaged in two types of policies. On the one hand, by converting loans into debt securities, a swap, and by allowing local governments to borrow by issuing bonds. Now, if you look at the government bond market, it has the whole suite of instruments from 3 months to 50 years. However, the liquidity of the market, which is very, very important for investors, is concentrated at the short end of the maturity rather than the mid to long term. And why is that? Because in a funny kind of way, all the bonds are held by banks. 70% of the bonds are held by banks, and that, of course, means that you don't have a liquid secondary market. It actually turns out, compared to the policy banks, compared to the government bond, are actually more liquid and often serve as a benchmark. Now, for a financial system and a capital market, government bonds play a critical role because they are the benchmark. They're a benchmark for corporates to borrow. So having a yield curve, that is all the instruments from the short to the 50-year or 30 to 50-year, is very, very important. And already highlighted that the liquidity is somewhat limited. So what information does the yield curve give us? And it actually turns out, surprisingly, that the information content is already quite good. It reflects macroeconomic conditions, so inflation, for example, or economic activity, industrial production indices. The transmission of monetary policy from short policy rates to bond rates is already quite good. And this is surprising, despite the fact that China's financial sector is still relatively closed, the impact from global financial conditions is already reflected in the yield curve. With this, I would like to pass the baton to my colleague, who will talk about credit bonds and some specific aspects.
Thank you. So what I'll do, I'm going to cover the credit bond market, so the segment of the overall bond market. I'm going to then focus specifically on one of the pressure points that Alfred has mentioned, which is liquidity risk, and get a sense of what kind of, whether it could pose financial stability risk and how to think about liquidity risk in that framework. But to do that, no, on the left. So I'm going to skip 2 slides and start with this one, actually. So the idea is that the credit market is a quite unique market. It's fragmented as segmentation, and it reflects, in some sense, the evolution of the credit market. So if you can think about the lines of maturity, there are a number of instruments that range between 1 year and, say, 10 years or 5 years, right? Those could be enterprise bond, corporate bond, medium-term notes, but they're very different in the sense of the market structure, because they have different regulatory bodies, different trading platforms. So the market is pretty segmented. So enterprise bonds are the oldest one. They start in the early 80s. They're primarily, the issuer are primarily SOEs or LGFVs. The regulatory body, it's the NDRCs, and it can be traded both in interbank or the stock exchange. And those, they require approval to be issued. Then if you move toward the corporate bond, that's a market that evolved more in the mid-2000s. They are primarily non-bank firms, same maturity, but they are regulated by the CSRC, and they're primarily traded on a platform which is the stock exchange. If you move toward medium-term notes, those are more recent, so it's around 2008. They are non-financial firms, a little bit shorter maturity. They are regulated by self-regulatory bodies, and they're primarily traded in the interbank market. And then you end up with commercial papers. Those are non-financial firms, less than a year, same regulatory body, and they trade primarily in the interbank market. So it's a very, in some sense, segmented market with different trading platforms, different regulators. That speaks, in some sense, also to the possible liquidity issue that I'm going to be discussing. Now, I'm going to go back one slide and focus for like a couple of moments on like 3 characteristics. One of them is the rating of this, the distribution of ratings. As you can see, they are pretty much skewed to the left. So about 95% of bonds, of credit bonds, are rated AA or higher. If you look at for comparison at the United States, in terms of distribution, it's only 5% that is above AA, and it's a much more normal distribution looking. And there's primarily 2 reasons one can point to. One is because there are more stringent regulatory requirements. So, for example, corporate bonds, you need to be AAA if you want to be marketed to a broad set of investors. If you think of medium-term notes, it has to be AA. So there's some requirements in terms of how this could be an offer to investors, in some sense push the distribution toward the upper left. And then also probably because this also reflects issues related to a perception of government guarantees, and that would push, again, another factor pushing the distribution toward higher ratings. In terms of pricing, the interesting point here, if you look both at enterprise bonds and corporate bonds, and trying to think like how much of pricing of credit risk or / liquidity is being incorporated into credit spreads, so running regression essentially of credit spreads over leverage ratio profits and then some sense of liquidity. Now, for corporate bonds, you can see that 1 percentage point increase in the leverage ratio gives you about 3 basis points widening credit spreads. So it seems to be a pretty decent pricing of credit risk. And similarly, 1 percentage point increase in profits, it's accounted for by a decline of about 2 basis points in the credit spreads. If you look at the same variable, leverage ratio and profits in terms of the enterprise bond, you get very little action there. Then there's the liquidity piece, which again speaks to what I'm going to highlight in a couple of slides, which is you would expect that liquidity risk would, in some sense, increase credit spreads. We don't find essentially that. There's a number of reasons. One could be that there's a lot of hold-to-maturity investors, so those are not mark-to-market. They're not really traded. Banks can play a large role, so they hold on their portfolio, or they can be used in repo. They can be pledged in repo, and that gives way to a complete different dynamics. This is the point I was making before in terms of implicit guarantees. If you compare non-SOEs with centrally controlled SOEs vis-a-vis locally controlled SOEs, you could see that in some form or shape, government guarantees are being priced into the spread because the spread is much higher for non-SOEs firms, then follows with local SOEs, and then the one which the narrower spread are the central SOEs. Now, in terms of like possible risk and narrow it down and on the liquidity risk and possible pressure point, let me spend a couple of minutes in a couple of characteristics in terms of trading here. So the chart to the left, the point it's trying to make is that bond market trading activity fluctuates quite a bit. And so you can see there's a big decline in around 2013. Let me step back for a second. There's 3 different bonds shown there. One is government bonds. So it's a rates bond, includes central government plus policy bank bonds. Then there's corporate bonds, and then the relatively newer product, NCDs. And now if you focus for a second on the first 2, the government bonds as well as corporate bonds, you can see they fluctuate. Big decline in trading in 2013, and again, a big decline in trading in 2016, 17, and that it's accompanied or associated with a decline in bond prices. So it seems to be that the trading pattern here is pretty much associated with what bond prices do. Now, the decline in the last couple of years has been, in some sense, cushioned by the fact that trading has picked up in a new segment of the market, which is NCDs. Now, this procyclicality, if you know, this cyclicality in terms of trading, it's very unique to the Chinese market. So if you compare, and that's what the chart to the right does, trading volume, look at over 5 years, interquartile as a share of monthly volumes. So you can see that about 80% of trading, it's in between essentially 25th and the 75th part of the distribution. It's about twice as much as other emerging markets. If you look at Brazil, India, Russia, and it's about 8 times larger than in the United States. So it's a much more dispersion in terms of this trading than peers or more advanced financial sectors. Now, another point to make here, that there's a tight link between trading and financial conditions. So the chart to the right shows the positive correlation between repo volume and trading volume. You can see it's a pretty clear positive correlation. And what it says, in some sense, is that the two tends to move in parallel. This is short-dated repo, so it's between 1 day and 7 days. One way to read this is that bond transactions, in some sense, are being financed by short-term leverage, right? So this raises a number of issues related to maturity mismatch, liquidity mismatch, and liquidity risk. Or another way to look at it is that there is a decline if you compare one-band Shibor with daily average turnover. There's a pretty clear negative correlation here. So you can think of like the relation between rates here and volume two ways, right? Either this reflects carry trades or it could reflect market making. I think we tend to put this in terms of carry trades for a couple of reasons. One is because, as I'll show in the next chart, the repo volume is multiples of actual trading market volume. Because repo in the Chinese market, it's pledged repo, so you cannot rehypothecate. And ultimately also because it's very difficult to short bonds. So it seems that this kind of these two patterns together seems to suggest that there's a lot of carry trades going on, and a lot of these bonds are being, in fact, financed in repo, short-term repo. And then finally, this is maybe to make the point of this liquidity risk. If you look at the ratio between repo borrowing outstanding and average trading, it's about 20 times. So that means that the trading in the repo market is about 20 times the amount of trading in the more traditional, in the secondary market. So typically, if you think of investment vehicles, essentially there's no need to sell here into a liquid market. What they do essentially, they can essentially finance themselves in the repo market. So it's just a liquidity stress here, and your choice is sell in the secondary market. So suppose you face withdrawal. You can either sell in the secondary market, you can continue to roll over your repo, or you can use deposit. The suggestion here is that there's a heavy usage of repo market, especially at times of distress, which is in some sense what the chart to the right shows. That there is a tight relationship between the ratio of repo borrowing to trading volumes. When repo volume goes up compared to secondary market liquidity, it's associated with increasing the repo market. And so in some sense, this seems to suggest that there's limited ability in the secondary market liquidity to absorb liquidity shock. And so what happens is, in some sense, creates a tight relationship between funding risk and liquidity risk, which could be a potential pressure point in terms of financial stability. And I'll pass to Baton now.
Okay, so for the remainder of the presentation, I will talk about some of the reform policy recommendations that we made in this book, as well as the development of China's offshore bond markets. As you can see, in this book, we are advocating a reform agenda that has a very long list of policy measures. Some of these reforms are to address some of the practical obstacles in the bond market, and this actually can be done in the short term, but with very long-lasting benefits, such as clarifying and unifying regulations when it comes to tax treatment for foreign bondholders. But some of the reforms are more difficult. They require much more significant policy effort, as well as political capital to push forward these difficult reforms. So I would like to use, as an example, the implicit guarantees. And as my colleagues have alluded to in their remarks, there's this widespread perception in China's bond market about these implicit guarantees, the belief that the government has the ability and the incentive to protect certain types of companies from defaults, from bankruptcy, for the sake of economic and social stability. And this is a belief that's widely shared by market participants, investors, corporations, financial institutions, and even local governments to some extent. And they had very good reason to believe that that's the case, because from the issuance of the first credit bond in China in 1983 until 2014, there was virtually no defaults whatsoever in China's bond market. And that's very rare in the international context, to say the least. Even after 2014, as you can see from the chart here, there has been a quite substantial increase in terms of the amount and the number of defaults in China's onshore bond market. But if you compare it to the global average, it's still quite low. I think the latest number for the default rate for 2018 for China is 0.79%. And compared to the United States, I think it's around 2%. So it's still quite low compared to the average in other major economies. And these implicit guarantees, not only they foster this moral hazard, they also lead to mispricing of risks. They lead to excessive risk-taking on the part of investors, bond issuers, and the local governments and financial institutions. So this can be very detrimental for the long-run development of China's bond market. And one particular type of corporate bonds in China is the so-called Chengtou bonds or urban construction bonds. These are essentially bond instruments issued by local government financing vehicles. They are essentially local SOEs who borrow on behalf of local governments to undertake major infrastructure projects. And as you can see from the chart here, these type of bonds became very popular in the aftermath of the global financial crisis when the government was trying to implement this massive stimulus package, but local governments were constrained by how much they could borrow formally from the capital markets. So in turn, they instructed the local SOEs to borrow on their behalf to finance these large infrastructure projects in the country. And the perception is that from the market participants' perspective, because these SOEs were borrowing on behalf of the governments, these bond instruments were guaranteed by the local government's credit. So till this day, there hasn't been any defaults of LGFV bond, despite of the changing financial conditions in the country, the business cycles, the variations in terms of economic development and the quality of investment across different provinces and regions in the country. So this is clearly a very serious issue in China's bond market for its future development. But to dismantle implicit guarantees, this would require a very careful sequencing of reforms. Because any radical change may lead to a massive, disorderly repricing of risks, and this could lead to solvency issues for not only corporations but also financial institutions who hold these bonds as investment vehicles. So in this book, you can find a more detailed prescription, the recommendations that we made in terms of how to remove these implicit guarantees in a gradual fashion. And this is also the recommendations that the IMF made in the 2017 Financial Sector Stability Assessment for China. So one specific policy, so I'm not going to go over the long list of policy recommendations that we made in terms of removing implicit guarantees, but I do want to point out to one particular recommendation, that is to strengthen the capacity of the financial regulators in China. And as you can see here, the Chinese capital market has been expanding very rapidly in the last decade, both in terms of its size and also in terms of the complexity. But at the same time, the number of staff, the number of officials working in the central offices of the financial regulators has remained the same. So it has become very challenging for the regulators to keep up with the development of the markets. So it seems to us that it is critically important for the regulators to be able to expand and to continue to strengthen their capacity so they can effectively regulate and supervise the development of China's capital markets. And the government has indeed taken some steps to address some of the issues that we discussed earlier. Just to name a few, there was this committee spearheaded by the PBOC to unify regulations across different segments of the markets. There's this opening up to the foreign credit rating agencies. I think S&P has obtained license to rate Chinese domestic firms, and the other two, Moody's and Fitch, will follow suit. And there's also some clarification in terms of taxation for the foreign bondholders, enhanced communication by the PBOC. Also importantly, the inclusion of China into the global financial market indices, the equity index as well as the Bloomberg Barclays Bond Index, has been followed by a surge, a very strong capital portfolio inflows into China. By some estimates, the inclusion into the Bloomberg Barclays Index alone could lead to an inflow of about $100 billion US dollars a year, just passively inflows because of inclusion of the index. So in the next two slides, I would like to briefly talk about the development of China's offshore bond markets, which have been closely linked to the development in the onshore markets. Partly because of the need for the Chinese corporations to diversify their funding source, partly because of the government's policy agenda to gradually open the country's capital accounts and to promote the international use of the renminbi. So the two markets that we discussed and we studied in this book are the offshore RMB bond market, the so-called dim sum bonds. These are bonds issued by corporations in the Hong Kong market that are denominated in renminbi. The issuance has increased steadily since the early 2010s, and it has been closely correlated with the onshore-offshore yield differentials. So what does it mean? It means that judging from this empirical evidence, the onshore Chinese corporations do use the offshore renminbi, the dim sum bond market, as a platform to mobilize offshore renminbi financing, especially when the domestic funding conditions tighten. And for the global investors, of course, this market offers a vehicle for them to increase their holdings of renminbi-denominated assets. And this was particularly important before these foreign investors were given more access into China's onshore capital markets. And another offshore market is the corporate bonds issued by Chinese entities denominated in foreign currencies. Most of them are denominated in the US dollar. And it has also experienced a very rapid expansion since the global financial crisis, like in many other emerging market economies. The driver for it, according to our empirical study, the sort of the expansion of China's offshore corporate dollar bonds has been closely linked to the opportunities of carry trade, in the sense that the Chinese entities do tend to issue more dollar-denominated bonds when the renminbi is appreciating against the US dollar and vice versa. So if you look at the chart on the left, when the renminbi started to weaken against the US dollar, that actually led to Chinese entities unwinding their carry trade positions. And this led to a large swing in terms of capital flows into China in the episode of 2015 to 16. Okay, so finally, please just allow me to summarize the main takeaways of today's presentation. China's bond market has great potential. The inclusion in the global indices provides a further boost for it to play a more important role going forward. And I think critically important is that the Chinese leadership is determined to further open and develop its capital market, including the bond market. And this can bring significant benefits to the economy in terms of serving the real economic growth, in terms of facilitating the diversification of the growth, and also to promote the international use of the renminbi. Some of the reforms are low-hanging fruits, meaning that they can be done in the short term, but they can have long-lasting, very positive returns down the road. But some other reforms, like the ones that Chang Yong mentioned in his opening remarks, removing implicit guarantees, enhancing corporate governance, these will require significant effort and political capital to push forward. And It is our hope that our book can help facilitate the policy debate when it comes to bond market development and will help the formulating of the reform measures going forward. So thank you very much. This is the presentation.
Actually, you can come here. Would you like to? Would you like to use that? Okay, sure. Okay. All right. Okay. All right. Sure. Okay. Thank all three of you. Terrific coverage of the issues in the book, and it shows you how far China's economy has progressed, but also some of the significant challenges that still remain. I want to now invite Mark Sobel to offer some initial commentary on the book. Mark is a non-resident senior advisor with the Simon Chair in Political Economy here at CSIS. He served as the U.S. Deputy U.S. Department of at the U.S. Department of Treasury for nearly 4 decades, including as Deputy Assistant Secretary for International Monetary and Financial Policy from 2000 to early 2015. From 2015 through early 2018, he was U.S. Representative at the IMF. At Treasury, he led the department's work in preparing for the G7 and G20 finance ministers' meetings and central bank governors' meetings, formulating U.S. positions in the IMF, and coordinating the work of Treasury and regulatory agencies and the Financial Stability Board. He was also chief U.S. financial negotiator in the G20 from 2008 to 2015. In the 3 years following his role at Treasury, he has served as U.S. representative at the IMF board, as I said, articulating U.S. positions on topics ranging from IMF financing issues such as quotas and backup resource lines and the fund's balance sheet to general policy issues such as the RMB's entry into the SDR basket. Mark, look forward to your comments. Thanks.
Thank you. First of all, it's a great honor to be here. I thank CSIS and the presenters, but mostly I want to thank all the authors of the book for a consistently first-rate, high-quality tome, and Alfred and Marcus for, Marcus Rudlauer is not here today, but thank you for bringing it all together. The chapters lay out issues clearly, crisply, thoroughly. They highlight key policy recommendations. Many of the recommendations are repeated throughout. I don't view that as a redundancy, but rather as driving home some very critical key points. The future of China's bond market is extraordinarily important for the global financial system. China's growth model has relied heavily on bank-fueled credit growth, and the big Chinese banks largely direct credits to SOEs as part of an investment-intensive manufacturing growth model. As the book notes, the private sector borrowers face much higher bank charges. But China's investment is increasingly inefficient, and China needs to transition to a more sustainable, consumer-oriented and services economy. In recent years, we've seen Chinese savers looking for alternative investments and borrowers seeking finance via unsound shadow banking flows. Flourishing bond markets can provide an alternative source of lower-cost capital to creditworthy private borrowers. A healthy bond market would create pressures for a more efficient Chinese banking system. The task is enormous, and the book well illustrates that creating a dynamic bond market has many critical dimensions that need to be tackled. So before launching into a bit of that, I wanted to note that I worked a good bit on Chinese financial market issues in the mid-2000s when I got up and running and chaired a U.S.-China financial market regulatory dialogue that lasted a few years. And at the time, the Chinese bond market was a shadow of its current self. There were different segmented bond markets, as Fabio alluded to. The NDRC conducted merit-based regulation. The CSRC was trying to promote corporate bonds. And the PBOC was seeking to create a more liquid bond market focused on interbank financing. Now, I offer that reflection because one often wishes that China would speed up its gradualism. But in thinking about the issue for today's presentation, I can see that much can change over time because a little here and there begins to add up. Today, as others have stressed, China's bond market is now the world's third largest and on the cusp of being included in various global bond indices. Some things have changed, though some of the past problems still remain. So turning to some of the key points from technical chapters that struck me, several highlighted the yield curve. I saw still a significant disconnect between movements in Chinese and global yields, which is to be expected given capital controls and substantial room for increasing China's integration into the global financial system. Chapter 3 did a good job in discussing the government bond market and the improvements made, but also inefficiencies, including insufficient liquidity, as Alfred highlighted. And it calls appropriately for greater liberalization. I'd perhaps have enjoyed a bit more discussion of the differences between the role of on and off the run securities on liquidity, especially given what Alfred alluded to, which is the bank's buy and hold strategies. I was struck by a chart showing a seemingly significant spread between China development bond and Chinese government bond yields. The text said that policy bonds are issued by the government and perceived as risk-free. But if that's the case, one wouldn't expect to see a spread. And this all reminded me a bit of Fannie and Freddie, a story that ended unhappily for us. And it also reminded me during the crisis, I met the head of a failed European bank who said that his team thought they were conservatively buying higher yielding AAA paper, and they never asked why, if the paper were AAA, didn't it have the same yield as risk-free treasuries. And that brought me to the critical chapter on tapering implicit guarantees and bond market defaults. So this is chapter 13. Ding was one of the co-authors. I immensely enjoyed this chapter. So the chart showing lower central and local government spreads versus large non-SOE spreads spoke volumes. Fabio put this one up. And I think it vividly illustrated the author's view that SOEs are seen as backed by the state. Local government financing vehicles and the subsequent swaps reinforce the perception of these guarantees. So defaults can help cure such perceptions, and defaults have been on the rise, which should contribute to better due diligence, evaluation of credit risks, and market pricing. But as the author suggests, the authorities should be far more tolerant in allowing defaults. Now, Ding referred to sequencing and gradualism. I think that's justified. Of course, going slowly raises chicken and egg questions as well. And so balancing these considerations is not easy. And the author has also well described that in an opaque fashion, investors may still be getting bailed out behind the scenes. Regrettably, as was noted, the incident of default applies far more to non-SOEs than central and local SOEs, even though there are major problems in the latter categories. Fabio, in his presentation, did a very good job in discussing problems with credit ratings, and that the bulk of ratings are extremely high, even if some onshore AAA bond issuers in international markets may be seen as high yield. The authorities need to allow credit rating agencies to play a stronger role in fostering a culture of credit differentiation. Fabio also did a very good job on a point that I would have even liked more drawn out in the book, which is the regulatory fragmentation and how that complicates development of the bond market. So, in commenting on the US regulatory structure, I've always said that nobody should emulate our system. The best I've ever said about it is that it reminds me of Mario Draghi's comment on the euro. It's like a bumblebee, a mystery of nature, because it shouldn't fly, but it does. And I'm not sure the euro or the US regulatory structure flies well, but we certainly haven't had the political courage to tackle our structure. But I hope China will heed the book's recommendations. Aside from government bonds, I see a clear case for empowering the securities regulator, CSRC, working with PBOC. On the bond market and the foreign dimension, first let me thank Kai Guo, a colleague and the author of Chapter 9, for a lucid piece on many market structural issues that are very technical but that impact successfully opening up the bond market. I thought there were critical macroeconomic issues that could have been more thoroughly explored in the book. So the Bond Connect program allows northbound but not southbound flows, as I understand it, which underscores the role of capital controls. Foreign investors may want more certainty about moving funds in and out of China. Now, future prospects for low interest rates in China are good in my judgment. The authorities are good at restraining inflation. China's productivity is decreasing. And given high debt in China, there's an incentive for financial repression. The authorities, especially after 2014 and 15, are wary about significant RMB depreciation for fear it may trigger a surge in outflows. Now, I've written that in the near term I understand, the conditions for RMB stability against the dollar may be ripe. But with the current account surplus disappearing, and notwithstanding the potential for inflows that we've been discussing today, there's a lot of capital in China that's ready to move out. And history tells us that capital controls leak, whether you have good controls or not. So it could be that the RMB is going to be under significant downward pressure over the longer haul. Foreign investors, while looking to diversify portfolios, and that's going to be helped by the inclusion of China in the bond market indices, may hold back on active participation because of lower interest rates and limited prospects for an FX pickup. Now, having said all that, I remember very early in my career an admonition I heard from Arthur Burns one day, which was, anybody who thinks he knows where exchange rates are going is a fool. So I offer that caveat. I commend China for being a leader on green bonds, given environmental concerns at a time when ESG investing is gaining significance. In conclusion, this was an excellent work. It's a very important work. It merits praise. There were two topics I might have wished had been more forcefully explored, and I'm going to challenge Alfred to speak to them. The first is the nexus between capital controls, exchange rates, monetary policy, and the implications for the development of the bond market, which I mentioned. And the second is a more overarching one. It's the role of the state in bond markets. So President Xi is more statist than his predecessors. Credit is being allocated to a less efficient state sector. So, will China cut back on the allocation of credit to SOEs? Will China put a hard budget constraint on SOEs? Is China prepared to let firms default and bond ratings to reflect market pricing? My suspicion, having dealt with the Chinese for a long time, is that the answer is going to be a struggle at the heart of the evolution of the Chinese financial system. Reformers will take 2 steps forward and 1 step backward, and there will be significant change that adds up over time. And if so, the authors may need to reprise their excellent work in another decade to enlighten us again. Thank you.
Before we turn things to the audience and have get their comments and questions, I want to see if Alfred, Fabio, and Ding, if you all want to have give some initial feedback to the gauntlet that Mark threw down, or some of his questions, or if you want to wait. Very good comments that spoke to the overall themes, spoke to reforms, spoke to the credit market, and I don't know if you all want to take a chance to give him some initial feedback.
No, thank you very much. Really appreciated the comments. I think you basically gave us an idea for the next book. But on this issue of the involvement of the state and how can you do this in a way that seems compatible with what we know about China, I think that's what you were alluding about. And I think it might be important to distinguish a little bit between flow and stock issues. So there are SOEs that are not performing, sometimes called zombies, and they ultimately need to be allowed to exit. I think the authorities seem to be willing to do that. There's a lot of talk about allowing SOEs to exit. I think where probably people from outside of China and within China would have differences is the way of how to do it. I think when we're talking about exits, we're talking about market-based maybe thinking of bankruptcy, defaults, those type of things. Whereas in China, often there's a discussion about administrative closures. Now, you can close them either way, but of course, you have two problems. One is that part of the cost will be socialized by putting on the balance sheet of the government. And the other one is you might be sending a signal in terms of moral hazard going forward. But that's a stock issue. One could potentially see that over time, China will be closing these inefficient zombies in a way that is halfway between the market and an administrative process. The other part, and that of course is critical going forward, is that you impose hard budget constraints going forward and allow the market to play a more decisive role. That it requires that you strengthen your resolution frameworks, and that you ultimately also apply them. I mean, we looked at a colleague of us who used to be our chief lawyer at the bankruptcy laws, for instance. And if you look at the bankruptcy laws in China, they're on paper not that bad. The problem is actually implementation. It will probably be a gradual process. On the broader question about the Bond Connect being sort of like a one-way road, you can invest in Chinese bonds, but Chinese cannot invest in global bonds. Now, that does not mean that the investors that come in can go out. So in that respect, it's an open capital account for the investors, but there are constraints on Chinese investing abroad. Now, in general, the approach that China has had in terms of opening up its capital account has been consistent with the institutional view of the fund, which, among others, suggested that inflows before outflows. Again, the authorities have communicated that they do intend to allow the southbound opening up, but they probably will do it very gradually. Now, we're among those that say be careful on the capital account side, because there are many conditions that you might want to strengthen further. The point that we're making is on the exchange rate, more exchange rate flexibility. But exchange rate flexibility without having a stronger policy framework, including the monetary policy framework, where interest rate ultimately plays a more critical role, and maybe even on the fiscal front, then that's also very dangerous. So again, it goes back to the sequencing argument. But our emphasis on the macro financial side is continue moving toward a flexible exchange rate system and strengthen monetary and fiscal frameworks. I think the broader question on the capital account, is a perennial one. And again, we touch upon it in the book, but it was not meant to be a focus because I think that could be the next book that we could write.
All right, Fabio or Dean, any additional comments you want to have?
Maybe one observation on the opening up or inclusion of Chinese instruments into indices. That has positives and negatives, in the sense the positive, if you want, is you have capital flows coming in. The reliance on more passive kind of investment, benchmark driven, exposes you though more to global factors and makes you more sensitive to what's going on, which means you become more sensitive to US monetary policy, global risk appetite, and so on. So those are things that in some sense need to be balanced.
And maybe just a very quick response to the point that Mark raised. Why are we advocating for sequencing reforms in terms of implicit guarantees? I think what we're trying to say here is this is a very difficult thing to do. It requires concerted efforts on multiple fronts. Apart from the policy and political decisions that need to be made, there are practical issues that need to be overcome before even we go to the policy stage. For instance, one theory that why the regulators have very low tolerance of bond market defaults is because they simply don't have granular enough information in terms of market liquidity, in terms of networks of the holdings of these bonds across financial institutions. So once they have the enhanced strength in their capacity, once they have enough information to make a better judgment, that will give them more confidence to allow the market to respond according to the demand and supply fundamentals.
If I could just follow up on that last point, which gets to this broader question of the implicit guarantee. Caixin and others report, if you look at the maturity of bonds that are corporate bonds that are out there right now, you're going to have a big spike in bonds that are coming due next year. Is this an opportunity to address the implicit guarantee problem and allow some more defaults? Or do you think that they're going to need to be more gradual about this because of the insufficient information or the shock that they are feared that that might cause on the system?
Yeah, I think the fact that a lot of the instruments are maturing, we highlight that as a particular risk factor, and you need to think about how you go about doing it in a way that is not disruptive. I think the problem with the system is where for the longest time the government has insured everything. The moment you start, at one particular point to change, it can have massive implications of expectations. So again, one has to be careful in doing this. And there is no panacea. It's not that you can pick up a textbook and say this is the right sequencing, these are the right instruments. At the end of the day, it's a little bit trial and error.
Okay, terrific. Okay, everyone has been amazingly patient, but I know you all have some questions. Why don't we take a series of questions together, given where we are in terms of time. If you'd like to ask a question, raise your hand. Someone will bring a mic to you. If you could just state your name and your organization, and then we will go on to the next one. We'll start here in the second row.
Thank you very much for a great presentation. I'm Albert Keidel. I teach a graduate course on the Chinese economy at George Washington University, and I worked under Mark at the Treasury Department quite a few years ago. My major comment as a specialist on China is that the whole thrust of the report and the criticism, for example, of SOEs doesn't really seem to take into account China as a second-best economy to the degree that it is a second-best economy. And so the treatment of state-owned enterprises as quasi-public institutions that serve purposes that the market really can't serve seems not to be part of this presentation. It may be in the report, but there is a spectrum of public goods, including the LGVs, which were a major solution to poor management of public construction projects, and that seem to be working very well. And the idea to put some kind of hard budget constraint on them is sort of almost violating the idea that markets at this stage in China's development are really very inefficient and don't provide the kind of information that you need. And so with that sort of nod to state-owned enterprises, Mr. Schiff said that China had a very heavily banking-oriented financial sector, quote, for a country like China. But there have been countries like Japan and Korea in the past that had exactly that kind of system at a stage like this that was really quite successful. So, and with the deleveraging that you mentioned, isn't that, if you're going to protect some state-owned enterprises for a lot of good reasons, then the deleveraging will hit the private sector most. So these are not necessarily systemic or structural issues, but really part of the current short-term macroeconomic requirements. So I wonder what your thoughts are on those comments.
In the front row, then, we're going to come as well. Question.
Hello, John Phipps with S&P Global. I was wondering if the authors of the book looked at some of the regulations that have created what essentially is this AA and above preponderance. Essentially the most, I think it's 97% of all bonds are issued have a AA or above or something like that. And then you look at the regulation, for instance, CBIRC, for example, has a regulation that says insurance companies can't invest in any company below a AA or something like that. Is this also creating the problems, and do you address that in the book? Thanks.
Do we have anyone else out there who wants to start in? Those are two excellent questions, though. All right, we'll hold off there. And who wants to respond to these two?
Maybe I can respond to the first question about the role of LGFVs. No, I think this is actually the response that we often were given when we were talking to the Chinese officials. That given the current development stage of China, LGFVs and SOEs, they serve the purpose of allocating and also utilizing limited resources efficiently. I think the key issue here, as we highlighted in the book, is to the extent that risks are not correctly reflected in the pricing of these debt instruments. I think that's a major risk for from our perspective, not only because of the misallocation of resources through the market forces, but it also creates this moral hazard that risk is not going to be as large as as in the typical normal market under normal market conditions, and that actually leads to very excessive risk taking and credit expansion in China, which is one of the most major policy issues over the last 5 to 10 years. And that leads to the sort of the concerted effort by the regulators and also by the central government to deleverage. Is they recognize that the accumulation of credit, is accumulation of vulnerabilities. If you don't address it now, over time, these vulnerabilities will get to the level that's going to cause a very disruptive impact to the economy.
Yeah, and I think the key here is that we're not questioning the benefits of state-owned enterprises or local government financing vehicles, but what we have seen is an increasingly less efficient allocation of credit, and that ultimately you want to address. And that kind of relates to the question about banks versus capital markets. I think it's a perennial question, I think, in the literature. At what stage, what size? There are different models in the world. Even when you're in advanced economies, you might still have a very bank-based financial system. I think that's what you're alluding to. But I think it's the very same authorities in China that are not so happy about the current structure of the system, where you basically have a few oligopolistic behaving banks, or that's often how it's perceived, that does not provide adequate financing to part of the dynamic future economy of China, which in part is the private sector. The private sector is deprived of credit, and so there is now an effort underway to facilitate financing to private enterprises, small and medium enterprises. While that might help in the short term, in the end, if you just start subsidizing the private sector in addition to having maybe SOEs that benefit from certain implicit guarantees, then that won't solve the problem. So ultimately, you have to basically create a level playing field.
Maybe a couple of words on the deleveraging part. So the way we look at this in the Global Financial Stability Report, think about a system where there are shocks that occur which are unforeseeable and we don't attempt to forecast. Then there's a global financial condition, or Chinese financial condition in this case. Then you have a number of vulnerabilities that act as amplifier to the shocks. And that have impact for your distribution of growth in some sense, right? And so some of the discussion here is about these vulnerabilities that build over time, part of it because of the global interest rate environment with rates very low for 10 years, part of it are endogenous to the specific of the Chinese system. The point is to think in terms of this intertemporal trade-off between tackling vulnerabilities today and respond to what the macroeconomic environment is, and intertemporally whether you tackle them today or you let them build over time. In some sense, you need to pay the price tomorrow. So it's that intertemporal trade-off where, in some sense, the policy needs to take a stand. How much you want to cushion the economy today, and vis-a-vis let these vulnerabilities continue to build. In terms of the deleveraging process, in the Financial Stability Report of April of last year, we tried to have simple schematics of the shadow banking when this deleveraging process was going on. And at the core of that system that has essentially borrowers and lenders, and then the top 5 banks, the smaller banks, the shadow banks or trust finance companies, and then you have these investment products. What keeps the gel, what keeps everything together here, it's implicit guarantee in some sense. So if you start removing those implicit guarantee, you have this very complicated system that starts falling apart. And so how to think in terms of sequencing, where you want to act. And it is true that if you start shrinking the shadow banking, you hit the specific part of the banking sector, which is the smaller and medium size, which have specific sorts of funding relying on shadow banking, but also they have some clients at the end, which is the private sector, which is the corporate bonds. And so who hold those bonds? What is the impact? Those are, I think, are some of the issue to think about, and how to think intertemporally, what you want to do today versus what you want to do tomorrow.
Maybe just one comment, because it's your favorite subject as well, on the credit ratings. You're absolutely right, but it's in part because it is regulated. Basically, you cannot issue if it is below a AA, so you don't have anything else. And there is a debate now whether one should have the whole spectrum like in other countries. But then you also need quality information and data, and that goes to one of our suggestions. It's the integrity of data. As an investor, you ultimately need to know what the risk is. So those probably go hand in hand.
Additional questions? All right, while you all are thinking of them, I've got one. I want to ask about the indices. And I want to bring this back to the debate we had a few years ago about the RMB getting into the SDR basket. At that point, there was a debate about whether it was really ready. And there was, on one side, there was, to some extent they're ready, but even more important, China is so large, such an important trader, that you can't not have it in the basket. And then there were others who raised a bunch of worries. Nevertheless, at the end of the day, IMF included it. We're not talking about including Chinese bonds in any new IMF index, or et cetera, but you mentioned the Bloomberg Barclays Global Index. Is there a reasonable argument to be had over that, or is it basically a very different kind of conversation? That is, China's big economy, its financial sector is very large, the scale of its bond market is so large, it started to open up to receive global investment. And so it's just something that should be done, but done eyes wide open. Everybody should be aware of the opportunities, but also the challenges. I'm not asking whether we should agree or disagree, but what is sort of the balance sheet of issues and risks in thinking about that? If we had someone from Bloomberg or Barclays, that I'd give it, yeah, they'd help us. So I'm asking us to just sort of walk as providers of public goods and defending the public interest. How ought we to weigh the question? Instead, not just coming down on it, but what are the pluses and minuses or issues to consider? And then anyone happy to weigh in?
Maybe from our side, in the end, we're economists. We think about cost and benefits, correct? So when you make these decisions, you think about the cost and benefits. And this goes back to maybe some of the initiatives that we've seen in the past. The process of inclusion, it was not a decision overnight. Bloomberg Barclays put on the table a number of reforms that the Chinese authorities had to implement. They included a clarification on tax issues, for instance, and a whole range of other things that are critically important for investors to make a decision to come into the country. So by offering to be included, you're also setting a benchmark, and you say, if these criteria are reached, then we as an investment community are looking at, again, the cost and benefits. Now, apart from the unique specifics, I think one thing is very clear, that China has, as an investor, some unique aspects. Its economic cycle is not correlated to other cycles. So, you might have an interest to expose yourself to China from that point of view. But in the end, it's this balance between, cost and benefits.
Okay.
Maybe repeat the point I made before, in the sense that
Sure.
I think it's part of a broader trend to move away from active managing to more passive benchmark-driven investment. And that's been growing globally over the last 10 years. If you track assets against benchmark, any benchmark you can take, the assets been going up quite a bit. And so that, particularly because you're at this stage of development, exposes you to more global forces. That it's part of the game in some sense. And you're exposed to US monetary policy, you're exposed to risk appetite, and it's not just China, it's part of this program. And this other country, of course, is the weights are going to go down. And so if money goes, either the pies gets bigger and then they keep the flows, the pie doesn't change, money goes there, it's going to come out somewhere else.
I think just to make a quick point based on something Alfred said, which is when China entered the SDR, the PBOC pursued the entry as a means to promote some important liberalization measures, some important opening up measures. So on the trade numbers, there was no question. On the finance, presumably you could have interpreted them either way, but there was some growth in the numbers. The PBOC used this internally to push reforms. That was something we welcomed. We've always worked, when I was in government, we always worked very closely with the PBOC. They're first-rate, talented economists interested in moving forward, and we certainly always wanted to work with them and help them.
I got more questions, but I'm going to let folks here ask if you've got questions. Yes, we can go in the back.
Andras Strado at the IMF. Thank you for a great presentation. I've got a question on a mundane subject of electronic trading platforms. If you're an investor and want to buy a US Treasury or a German Bund or UK Gilt, it's just, but also corporate bonds in those currencies, it's just 2 clicks away on electronic trading platforms like Bloomberg Bond Trader and so on, providing enormous pre-trade price transparency. My understanding is that this is missing in China, and it's one of the big roadblocks for investors to get involved more. So can you comment on the state of play and what's planned? Thank you.
So I don't think that the issue is the diversity of platform. I mean, there's different platform in the US also for Treasury securities. There's a different platform for corporate bonds. There's trends related to technology in the US, toward more exchange traded, high frequency, and so on. I think the issue that I was trying to allude in before perhaps, and this is one side of the equation, which is the supply of credit. There's reforms related to the demand of liquidity and the reforms that can be linked to the supply of liquidity. The trading, in terms of supply, trading is a piece, but there are others that includes having market making, that it's more in line with more advanced financial sector market making, having a broader suite of instruments that includes derivatives, having a repo market where you can rehypothecate and so on. So I think the platform, yes, there's technology that can improve and improve access, but it's a broader issue of demand and liquidity in some sense. I think they need to be addressed.
Yes.
Thank you. I'm Zhang Qi with China's Taixing Media. I wanted to ask about the opening up of China's bond market in the context of the US-China negotiations right now. So ideally, what would the US or foreign investors want the China's bond market to be opening up, and what realistically would Chinese government would like to open up to the extent of how much opening up? Thank you.
The good news is that we're not privy of the discussions between, or maybe the bad news that we're not privy of the discussion between the US and China. But I think the issue of opening up is an issue that was articulated strongly last year at the Boao Forum, so way before the recent increase in the trade issues. Where President Xi articulated clearly that China was going to continue opening up regardless what. So that was very clearly articulated. And this issue about the bond market is actually a little bit more specific. So opening up the bond market is attractive for China for domestic reasons. Again, China is currently trying to ensure that all parts of the economy have access to credit. If the current structure of the system with banks or the large bank is not perfect, then the bond market could be a catalyst to facilitate, assuming that the conditions are in place. So it's very much in line with China's own development agenda. So I think that would be.
Let me just piggyback on her question, though. Something that we talked about more, maybe it's still talked about in financial circles, and it gets to the question of overseas bonds that China is. China issues overseas bonds in some in dollars, but not in the United States. I think that's correct, right? So, what are the pros and cons in terms of China eventually being able to issue bonds in the United States markets? What should American regulators be looking at in relation to reading your book in making that decision, or investors in terms of deciding, weighing risks?
Well, I think that at the technical level, really the reason for the Chinese corporation, or Chinese entities, I should say, including both corporate and financial institutions, to issue bonds in the overseas market is to tap into the dollar funding, regardless of the location of the market. So in that sense, if the United States regulators would open its market to the Chinese entities, I think that'll be welcomed by these institutions. And of course, I think one particular issue that we highlight in the book is, China, just like any other major emerging market economies, they've been very rapidly expanding their offshore dollar bond issuance in the last 5-10 years, and that came with substantial foreign currency risks that needs to be managed very carefully, not only by these entities but also by the regulators.
Just a quick observation, which is that the U.S. has pretty strenuous listing requirements for issuing bonds in the U.S. market, and we do accept IFRS accounting and whatnot, but still the standards are fairly high. The transparency demanded by the SEC is high. So to the extent that the U.S. is a large open market with good standards, I think it provides a bit of a halo effect for firms that are issuing here.
All right. Well, we've reached time. Alfred, Ding, and Fabio, thank you so much. Congratulations on the book. It really it sheds light on a part of China's economy that is increasingly important, but not understood nearly enough. Now we do have some understanding. Mark, thank you for your comments. Thank you, everyone, for your questions. I think what we've got is now some developments we'll look in the markets over the next year or two, and then we've also got an agenda for your next book. And so we look forward to the IMF coming back to CSIS before too long with your next analysis. Everyone, please join me in thanking our speakers.